So I muted one person. There's just some background noise. So the first thing we're going to go into, again, if you have any questions, you're more than happy to unmute and ask a question. You can also type in chat. I've got, 3 monitors, so I can see a whole bunch of stuff. And before we go real quick, I know I posted the link earlier, but if you haven't signed up for the newsletter, it's $9.99 a month. I quote unquote contribute to it as well. I post a lot of information on the broader spectrum of the market. If you do promo Chris, which I'm typing in the chat, if you use that, you get 20% off for 3 months, and you still get the 2 weeks free. So if you want to just do it for 2 weeks, see what it's like, go for it. So anyways, let's dive right in. So an option is a contract. So it's not a stock. So if you say, oh, I have a stock, options are different than options, but we won't go into that. But an option contract is the right, but not the obligation. So meaning you don't have to do it, to buy or sell a particular stock at a certain price and at a certain date. So let's just go into first what that technically means. So a good analogy is like a sports bet. So at the beginning of the season or whatever, or even if you want to bet on a Super Bowl, it's kind of literally betting on a stock or a team is going to go in a certain direction and for you to take profit on that. So this is what's called contract trading, which is not stock trading. I mean, you're still trading on the market, but in terms, in technical terms, that's what it is. You're contract trading. So I'm just going to go over just a super simple what you're going to see. So you'll see people in the group Let's Invest and Trade Together. They'll say, oh, I bought option blah 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 at blah blah blah. So let me go over what that means. So I'll just do ABC. So stock ABC at, and then they'll say a price, and then they'll put a date. So I'll just do this, and I'm going to show you a more concrete example, but I just want to go over what this all means. So when we're looking at, when someone says, oh, I bought option ABC at 20 for 716. So basically this just means, I'm going to write call. So they said, okay, a call for stock ABC at this 20 means $20. And then this is the date when it expires. And I'll go into what all that stuff means in a second. But hold on one second, guys. So when we look at those, so let me just highlight each one so you can see. So this call, that is if you're betting it going up or down, and I'm going to talk about what that means in a second. The second part is going to be the stock. And then you've got, this is the price. And I'm a horrible, if you guys haven't seen it, you'll see I'm a horrible drawer and just handwriting. And then this is the date. Okay, so just get that, what you'll see, because that's what a lot of people will say. They may not say, some of the stuff, but there are some things. This is what's called the strike. The date, or sorry, hold on one second. How do I delete this? Nice. This is what's called the expiration, or EXP. This is called the strike. So when you hear strike price, they'll say, well, what's the strike? And then the strike will say whatever that dollar amount is. And I'll go into what that means in a second. Then the stock, and then call or put. And I'll go over what those are. So there are a couple other things too these are acronyms or abbreviations of what some of these mean. Let me just write what those definitions are. ITM means in the money. ATM is at the money. OTM is out the money. All right. So just before we move on, are there any questions on just what a strike or expiration is and just what an option is? It's just basically a contract. No, a strike is going to be the price. Expiration means the date. All right. So, moment. So you have two types of options. No pun intended on this. You have a call and you have a put. So a call is expecting a stock to go up. A put is expecting a stock to go down. That's all it is. So a call means you're expecting a stock to go up in price. Maybe I should put that in price. And then a put is expected to go down in price. So what are some catalysts for some stocks to go up or down? It could have bad earnings, bad news. A good example to do a call. A good example was back in 2017 is when Disney and Comcast were bidding against Fox, 20th Century Fox. So a lot of people bought calls on Fox because they were being acquired. And the whole thing was no one knew how much they were going to buy it for. And there was a bid war on how much to acquire Fox. So that drove the stock upwards in price. So people would buy a call for that in that time. So a put is if you're expecting the stock to go down in price. So a good example for this is back in, actually, I think it's 2017 as well. Intel, the chip maker, the CEO had an affair with one of the office assistants. And that showed that, a good leader shouldn't have affairs. So that drove the price down temporarily. So that's people bought puts. So that's all it means. So you get money on that for that. So a call again is going up in price, puts going down in price. So that's all there is to know about what we're, in terms of a call. Okay. Now there are a couple other things you need to know is these contracts. Let me go to a new page. And I don't have these all out on purpose because that way you can see me typing. It's just a memory thing rather than you just reading what I'm saying. It's just the way that how the brain learns. That's kind of why some of these are blank and others are not, because it's just so you can see and so you can remember and learn. So option contracts, they go in 100s. And what I mean by that is one contract is 100 shares. So when you buy an options contract, you're technically like playing with or using 100 shares of whatever that stock is. So if I were just to say, just so you can see an example, if I were to buy 4 call options, that means you're expecting, I'm sorry, you're using 400 shares. Okay. Now, that's just layman's terms. There's some more technicals behind it, but just remember one contract is 100 shares, and that's a big thing because you're going to see in the next page some stuff that are going to be in cents, and then we'll explain what that means in a second. Okay.
Good info. Real good info.
Okay. Now, if you have traded stocks before, obviously some of this stuff will make sense. So a bid, and I'm going to highlight these for you. So the bid, that's what people are asking to buy it for. So if you attended last week, you remember me saying it was like kind of like a car sales. If someone's saying, okay, I'm willing to buy this at an auction for this amount, that's what that is. So the bid, that's going to be what people, let me do smaller. The price, what people are asking to buy it for. And I use pretty simple vocab terms, okay? Then the ask, that is the price, what people are asking to sell it for. Now, this brokerage that I took this from, this is from Charles Schwab. So it may be a little different, but the terminology is all the same. So the ask, that's going to be what this is. So this may be different on other people's ends. That I can't control. If I were to put up a thing for every brokerage account, it would take over probably like a lot of screens because there's just so many. The midpoint, this is what people talk about a couple of times, but not as much. Just the midpoint is the middle point of bid and ask. That's all it is. So you can see right here, $8.30 is the bid for this call right here. And we'll go into more detail in a second. The ask is right here at $8.80. The midpoints, it's just basically what's the average between them. So I don't know why the midpoint. Oh yeah, no, that's the midpoint. Yeah. Okay. Volume, that's just the amount that it's been traded for the day. So this is the amount of times the option was traded for the day. So again, one volume equals one bought and one sold. So it's not just someone bought one, it's the cycle of transaction. Okay. Open INT, that means open interest. So open interest is telling you how many people are willing to sell or buy the option. So what that means is that their bid or their ask price may be below or above, but the current amount right now, so if you were to look at this right here, let me highlight that. So this right here, that means there's currently 2,393 contracts that want to be purchased, you know, with that they're interested in buying it, but it may not fill the criteria of what the bid or the ask is. So a strategy that people look at is they look at the open interest. Now, if there's a lot of people looking to buy it, that could mean something. It could be that a lot of people are expecting it to happen, or it could be hedge funds trying to kind of, you know, do a sleight of hand, you know, look at here, but they're really looking over here. But now, am I a conspiracy theorist with this? No, it's just because you see a lot of open interest doesn't mean that everyone's in there because it's expected to do that. So you have to be careful, okay? With options, there is limited risk with it. It's not like when you buy a stock. So let me actually talk about that before we go into a couple more things. But when you look at options, people ask, why do I trade options instead of stocks? And I'm going to explain this in a second. Okay. Let's give me one moment. And I'm going to go back.
That's really what I'm interested in, because so far I've just been trading stocks.
Yeah, no, it's good. Well, there's higher risk and more reward. Okay. So why do you trade options? So if you remember, I was talking about these contracts are dealing with 100 shares of the stock. So a contract is 100 shares. However, you are trading a contract, not the stock. So what does that mean? Okay, so when we look at this data right here, so I was saying 100 shares. So when you look at this option right here, now, and I didn't really go into it as much, I wanted to go into more just identifying what this stuff is first, but looking at this particular options contract. This is from Microsoft. The strike, remember the strike is the price, is to buy this stock because it's a call at $272.50. The contract expiration is July 16th, 2021. So what this means right here is you're expecting Microsoft to pass $272.50 by this date. Okay. So, and we're going to go into what's realistic expectations and things like that in a second. But that's what this option means. Now, there are a ton of options, and I'm going to show you and break it down, and we're going to do a couple examples together. But that's what this means right here. So again, so if we were to trade this option, we have a contract to buy Microsoft at this price at 100 shares. Now I'm going to go into more of this stuff in a second. So when I buy this option, this contract's in 100 shares. So every time you see a dollar amount, so you'll see, let me do a different color. So you have this guy, anything that's considered a dollar amount, volume's not a dollar, open interest, if you just think about it, it's not a dollar. These I will go into in a second. Oops. Those are dollars, but everything you see that's considered a dollar amount, you're going to multiply by 100. Okay, so every dollar amount you see, x 100. So what that means, if I were to, uh-oh, these doggies. So what that means is if I were to buy this call option at $8.30, I'm really paying $8.30 times 100. So this option is $830. And I want that to pass $272. That's what this means. Now, I could do the same for the midpoint and ask. So, I mean, just multiply by 100. So $8.55 times 100. That's really the midpoint value of this options contract is $855. Ask $880. Okay. So just knowing how the option works. Now there's more stuff to it, obviously, but just knowing how it works. Does everyone in here understand how what the call means? Can you identify the strike, the expiration, and then the stock? Before I go on, because I want to make sure everyone.
I'll be honest, I would need a list of tools. I currently use Robinhood only.
Okay, so with Robinhood, I don't have Robinhood because it's a little different with their app. Because
I'm a little behind the curve there, so to speak.
No, you're fine. Yeah, with Robinhood, because Robinhood, generally people will buy at what's called market price. So you'll buy at the highest amount, which would be the ask, and then you'll sell at the bid, unless you set for a limit order. But with that though, does this make sense though? Because I know I'm using
yeah, everything you said has made perfect sense. I mean, I get it all. I'm just lacking tools. I guess basically what I'm asking for is what tools do you use?
Oh, I use Thinkorswim or Schwab Street Smart Edge. If you want to see, this is kind of like what I see. I use a computer for trading. I don't use a phone. The only time I'll use my phone for trading is if I'm in a trade, and if I want to execute, because what I have is I have a lot of text message alerts, and what happens is it'll send me alerts saying, hey, your option's at whatever price point it needs to be, and I can say execute or hold off or set trailing and things like that. In terms of tools, actually, I'm going to be doing a more in-depth of how to day trade or swing trade next week. So, but it's not with Robinhood though. So a good thing maybe is to look at Webull. That I can show how to do that stuff on Webull, because the desktop and the mobile version are similar.
I'm familiar with Webull.
Okay, yeah, because with Robinhood, I wish I may need to just download like a emulator and try Robinhood, but I don't have Robinhood. That's the problem with that.
Yeah, I, I started trading with Robinhood like 2 years before
Okay,
I met Personified or PersonaFi. But yeah, I'm trying to get away from Robinhood
right.
and into Webull, things like that. Um, I just looking for more tools to use so I can
Yeah,
monitor more.
sure. No, yeah,
More.
I would say Weeble's a good one. Robinhood's not that great in my opinion.
Right.
I've never
I
used,
agree.
yeah, I've never used Robinhood.
Yeah,
I know a lot of people say
it's
Weeble.
not great.
Yeah.
Yeah, Robinhood's not great at all. They take a week to do a transfer for money.
Oh wow.
So, like, yeah, if I want to transfer another $100 and buy $100 of INBD, it takes a week. So it's a little problematic,
Right.
so to speak.
Yeah.
So yeah,
So
and then I'm looking for more tools to monitor the market. I will admit I'm really new into the investing thing.
sure.
So
I understand.
I've been taking notes rampantly the whole time you've been talking. So
Oh, perfect. So anyways, so going back to the Y trade options is if you were expecting Microsoft to go upwards, you buy this call and you spend $830. Now, this will be considered a trade, not an investment, because there is an expiration date on when this contract ends. So if Microsoft does not hit this price point by this date, then that contract, what's called, is expires worthless, meaning it's worth $0. But this is where it goes into, okay, what would you like to do? So for example, this call option was $830. Now, if I wanted to buy, and again, these contracts are in 100 shares. If you think Microsoft is going to go up and you wanted to buy 100 shares of Microsoft, how much would that cost? Well, let me just look up what Microsoft is. So if Microsoft,
let me ask a question real quick.
sure.
Since you said it didn't hit that, whatever, in this theoretical timeline, it didn't hit that price mark. You're out that money, or
Yes, you are.
okay?
But
Thought so. Yes. Okay.
you can see right
Just
now.
want to double check.
No, you're fine. You can see right now Microsoft closed at $281. So this would be what this call would be considered in the money. So going back, I talked about these little terms right here. In the money means what it means. The price of this contract exceeds or is past that price point. So right in the money would be 272 up to, and it goes by 50-cent increments. So, there's that, but you just do simple math. At the money would mean if it's literally at what the price of the value is. Out the money is if it's out, not hitting that price point. Okay. So now again,
Gotcha.
going back, why would I do an option rather than invest in Microsoft? Well, 100 shares of Microsoft right now, let's just say it's at $280. Well, do the math on that. If I wanted to buy 100 shares of Microsoft, that's $28,000, right? So options contracts or options trading, it's quoted the poor man's trading, meaning if I wanted to buy 10 contracts of Microsoft, that means 1,000 shares. Well, what's 1,000 shares of Microsoft? That's $250,000. So now, however, this would be $8,300. And again, I'm just rounding. Okay. So what option contracts do is you can mitigate your money. Now you're not mitigating, well, you are not really mitigating risk, but you're basically putting out less amount of money in hopes that it goes upwards to then make more money. Because if you think about it, would you want to tie up $28,000? Maybe your whole brokerage account is 30,000. And you want to diversify. That's very important to diversify. Now, some people may argue not to. Some people may say just put it into one stock. But then again, if you put it all into one stock, look what happens. Good point would be GameStop or AMC if they bought at the high. So why do you trade options contracts? Is you use less of your equity to then get a return, right? So that's kind of where that is with why you do options. Is maybe you only have $5,000. Yeah, you can buy however many shares of Microsoft to in hopes it's going to go up, but you may not make as much. But again, you hold that. So the big thing with options is there's a time where it's gonna end. So you have what's called that time value for that. Whereas if you were to buy the actual shares, you hold on to them. So how they say the market is cyclical, meaning it just goes cycles. If Microsoft were to go down, you could hold on to it. If you hold on to an options contract, it will expire either in the money, at the money, or out the money. So going back to these things, if it expires out the money, meaning it doesn't hit that price point, it's worth $0. Now, if it's in the money, it's worth a lot of money. So that's why these are more expensive. And I'll go into a little bit more on that. But so that's why people will trade options rather than buying the stocks. Now, just like if you look for some stocks that are worth like $3 or $4, these options aren't going to be, how much, hundreds of dollars. They may be like $50. So a lot of people load up on a lot of them in hopes it's going to go up. But that's where I'm going to go next with realistic expectations. So when you're looking at these, and I'm going to pull up my account. So as you can see here, I'm just pulling up. This is Street Smart Edge with Charles Schwab, but I'm going to show you all the expiration dates. Okay. Now, how you pull these up on your broker, I don't have the answer to all of that stuff. Like Robinhood, I don't know. But as you can see right here, let me see if I can make this a little bit larger for you guys. Oops. As you can see, these are the different dates that have all the way up to 2023. So here's what I talk about. I'm just using Microsoft for this. So what people will do is they'll look at, and I'm going to all strikes so remember, strike is the price. So there are tons of strike prices for Microsoft, as you can see. Can you guys see that all right? I'm not sure. I can make it larger if need be. So let's think realistically. What people do is they just think, I'm going to buy OTM calls or out the money calls in hopes that the stock rises. So just think realistically. Okay, and now this is going into charting, and I know some of you may not know how to do that entirely, but if I look at Microsoft, the highest it's ever been in the last year was $283. The lowest it's been has been $242. Okay, so let's just focus on calls, meaning we want the stock to go up. If I'm looking at different strike prices, I see Microsoft, okay, 295, I see 290, I see 330. Okay, think about it realistically. Now, this expiration date is 7/16, so that's how many days? That's tomorrow. Do you think Microsoft is going to hit $335 in the next day if it's at $281? That makes no effing sense.
No.
Okay, and people will buy these in hopes that something will happen. And you can see that the price slowly decreases. So if you see this one right here, 282.50, math-wise, to buy Microsoft, meaning tomorrow, I want to buy Microsoft at 282.50. It's going to cost me, I'll just do the bid, it's 0.46. So again, remember, it's by 100s. So it costs $46 to buy this options contract. This one costs $11. Now, is it possible for Microsoft to go up $4 in a day? That's possible. I'm not sure if it's likely. No, I mean, it seems like it's roughly trading at about $3 or $4 up. So that's why these are cheaper. And I'm going to go into a couple other things too. So you may see people posting on our group. They may say, oh, AMC, oops, AMC, it's going to moon tomorrow. You see people do this and they buy, look, AMC right now is at $36. Let me focus in. This is a call to buy AMC at $145. And obviously it's for 1 cent. But look at this open interest. 56,000 people are trying to either buy or sell. The volume traded was 7,700. So you get some people, I won't comment on their intelligent level, but some people truly believe it's going to hit this price. Now, a realistic thing for AMC, and I'm just going by the technicals, meaning I'm seeing what the range is. You can see, and I'm just going real quick, AMC traded roughly between a $5 increment. So if you know what the range is, or the average daily range of $5, this is just a mathematical observation. If it traded within $5 up or down, then that may be a thing you want to look into if you're going to buy a call or a put. But we're just focusing on calls. Puts are the same thing. It's just literally flip everything upside down, but I'll go into that in a little bit. Okay. So that's what I really warn people is have realistic expectations. Now, with any stocks can go up or down. So realistically, now this I clicked on is January 20th, 2023. So that's a year and a half from now. Could AMC realistically be $55 in 2 years? Yes, it is actually quite possible. Could it also go down? Yes, it's quite possible. So the further out you go, that's why you see more people buy OTM or out the money calls or puts from a year or two out or a couple months out. That's why if you have the newsletter, Ken does about a month or two to have some leeway for things to go up or down. Now, if it happens within a week, that's you have to be realistic on what could happen compared to you YOLO or all that jazz. Okay. Questions on that before I go on, because there's a couple of little things that I wanted to talk about. The next thing I just wanted to very quickly talk about with this is this helps traders determine how to get out or how to get in. Oops. I bought the option. Oops. Now what? Okay. So let's just say we bought this call from Microsoft for $8.30. A lot of people like to look at the break even point. And what that is for a call, you add the price paid plus the strike. Let me highlight those. So you add the price paid. So I paid this, and then plus the strike. Oops. Plus the strike. So again, the strike was 272.50. So what break even means is if the call were to expire on that date, so this date would be tomorrow, it needs to hit what that break even point is for you to make 0 cents. Now you can sell beforehand, obviously, and I'll talk about that. So your break even point, so I'll just use BE. So just quick math is 830 plus 272.50. So that's what, 80. So 280 and 80 cents. So if you were to have bought this call option today, a good rule of thumb is what's the break even point? That's something you want to look for. So again, the break even point, that's if you were to just literally buy it and forget it till the end of the date of what the contract is. That's a good price point to look at, because once you pass that, this is what would be at the money. Then if it passes this, it's in the money. So looking at how Microsoft closed, it closed at 281. So even though it's right at the cusp of what this break even point is, this call option, even though we know what this is, but this call option has broke even, meaning it will make you some money. Okay. Now people may think, well, why don't I just hold on to it? Or why do my call options decline over time? So I need to explain how these how these options work, because obviously it's a little bit more complex than a stock, because you can say the stock goes up or down. Options have different variables with it. And that's why I'm gonna go into what these 4 things mean. So let's say again, we bought this for $8.30 or $830. Let me go to this. So the big thing that people look at is the delta. So delta is per $1 of the stock is how much the option will go up or down in price. So delta, I don't know if you guys know what delta usually is, but it means change or rate of change. So if I look at this delta, when I look at these call options, and with Robinhood, I don't think they show this stuff. You may have to go on on the internet, because there are tons of, they're called options chains, like a chain. So delta, so look at this delta. Now again, this is considered a dollar amount, so you have to multiply by 100. So that means for every price this Microsoft goes up or down at the current price, so times 100, so 0.97 times 100 is $97. So that means if Microsoft goes up $1, this call option right here is going to go up $97. So let's just round up to 100. So that means this will be $9. Well, I'll do the real one. Okay. So does this change? Yes, it does. And I'm going to go over some of that stuff, because the further you go in or out, it changes. But just the big thing is delta just means change. So if your delta, whatever that value is, times it by 100, for each dollar it goes up, this is how many dollars you're going to get if you were to sell. So I can go back and I can show you. So let's look at AMC. I'll just do AMC. So if I were to, let me make this larger. Hold on 1 second, guys. So if I were to look at an AMC for that's going to expire tomorrow, if I were to say, okay, if I bought this AMC call, so again, okay, so this is the stock AMC, expiration 7/16, which means that's tomorrow. Your strike is $39, meaning you want AMC to go past $39 by tomorrow. So I'm just going to go by bid. So if you were to buy this option times 100, let me actually write this down so you guys can see it. Times 100. So I bought this option for $54. Now the delta is 0.26. So if AMC were to go up $1 tomorrow, this is going to go up 26 bucks by $1. Then the next dollar, so you can kind of get an idea. So if I bought this at $54 and it's trading at $36, it hits $20 or $37. This option is now going to add 26 to it. That thing's worth $80. Okay. Questions on that? Because that one's a little bit more, I know it's not a lot, but it's still, you know, we're doing a lot of math. I don't know how long you guys have been in or out of math classes. Yeah. So now there's another thing that occurs. And like I told you before, there's time, because obviously we're doing a contract. So a contract has a specific date, so we have time. So that's where things can get kind of choppy, because again, if there's a bad market day and you have a bunch of calls on your portfolio, those aren't going to look too good. And because you have a specific date. So again, once it passes this date, this contract goes away on your portfolio. Either it makes you money or it makes you $0, or what they call expire worthless. The next thing is theta, which is right here. Theta is how much the option loses money per day. So if you can see, this theta it shows a negative, so 0.04. So 0.04 times 100. So that means this option tomorrow, if nothing were to change, just the day, this loses $4. Now others are higher because they're closer, but that's just what this theta means. Is just it's gonna lose $4 per day. Now this changes as it comes closer to the expiration date. Excuse me. So your theta will always be lower the further out you buy an options contract. So if I were to look, so this theta and we'll just use AMC, that way you can see something different. So this theta, so look at AMC. This is going to lose $33 tomorrow. So if you were to buy this today and it's $54 and it does not change in price, it loses $33. So this isn't going to be worth very much. But look at July. This theta is $21, and I'm doing that because I'm multiplying it by 100. This is 17. You get the picture, 15. So if I were to just calculate, if nothing were to change, but you saw, so you can see, I know it's kind of hard to see, but extended hours, it says $38.15. If I wanted to calculate what this option is worth by tomorrow, if it was at 30, let's just say it's $38, I can do that. I can do that by writing it down. So let's say I bought it at 54. Okay, it's going to lose $33. So I have to subtract $33. However, it went up $2. So look at my delta. So 26 times 2. Oh. Yes, puppies. So it'd be plus 26 times 2. So if I wanted to know what this options contract is, well, okay, so what's 26 times 2? So that's what, 52? 54 minus 33. So this is 106 minus 33. So that's going to be what, 73? So right now, my options contract, I made 73 bucks, or I'm at $73. So you'd say I made roughly 20 bucks. If you were to sell it right away, nothing changes. Any questions on that before we go forward? We're almost done. Nope. Okay. The next two things, gamma. Gamma is the change of the delta per dollar. So this goes, and it's just math. So essentially what this means is your delta will increase and the gamma will decrease over time. So if I were to look at this gamma, that means if the dollar goes up if it goes up $1, okay, so the delta changes to 97, whatever it is, it adds the gamma. So that means it now changes to $98, then $97. So it's kind of like a compound, because obviously the delta will increase as it approaches the money, and then once it passes it, it will increase. This will never go past $1, just so you know. So $100 will never go past it. But if you have a high delta, then that means that the option contract can go up or down quicker than others. IV, that's a good one. This means implied volatility. I always spell that wrong. There's an A in there. This just means what it means is how much is the stock being traded? Is it dangerous? So I mean dangerous by, is it a meme stock? Are there earnings? Because obviously that can show more volatility in the stock. That's all that means. This is a percentage. I try to go away from IVs that are higher than like 130%, because that means that options contract you're paying a lot more for the same thing. You just have to be careful. Now, is there an actual math equation that shows, how does the option price change based on the IV? There is, but it's super complex. And I mean, like, I can't just tell it to you. It's a very large thing. Just think of it as, if this were to increase, and if this increases, expect this to increase. I mean, I can show you. This is. Let me pull it up just so you can see. This is the formula right here. So I don't think I want to go into that, but so it's a statistics type thing. So just think of it, the higher this goes up, the more it's going to cost. Like if you see an IV of 500, like GameStop stuff, you're going to pay super amounts of price on that. So that just goes back to what's realistic. Will this hit this? What's the date? Those things. But that's basically the intro to calls and for options. I didn't really get into puts. I can go over puts. It's the same thing. It's basically just flipped. But does anyone need me to go over anything before or clarify, or we can look at another stock? Maybe you own an option already but weren't sure on some stuff that I can look up right now on my thing, on my end.
I have a question.
Yeah.
So you said a high IV is bad?
It can be bad and good, because let's say you bought a call or a put with a low IV, but then the IV goes up. Then if you're in it already, it's going to be worth more because it's more volatile. So there's more risk to it. But if you're getting into one with the high IV, that can be, it's like a double-edged sword. It's either good or bad. Like if you can see for AMC for tomorrow, this IV implied volatility is 154%. So that means that this stock is volatile. And you can see even further up to August, this is volatile. This is even more volatile because it's, again, what's realistic. Could AMC hit $39 by August 6th? Yeah, there could be another Reddit rebellion. So that's why. So basically, this is just telling you you're paying a higher premium than what you could have at an earlier time when it was less volatile, if that makes sense.
Yeah. Okay.
So it can be bad or good. Because like a good example is I bought Nokia puts. I know because I talk about Nokia and how I like it, but I bought Nokia puts right before the GameStop surge in January. And my puts, even though Nokia went up like $2, No, my puts were worth more when I bought them because it increased the volatility of it. So because the volatility is saying we don't know the direction of where this stock is going to go. So if you think about it in terms of like a good one right now is like used cars or like computer graphics cards. Why would I want to pay retail price, or why would I want to sell it for retail price when I know I can get more? Because you're not going to be able to find a used car as as good as before. Things like that. It's kind of like market volatility. It's the best way to say it.
Okay.
So like so here's AMC. Let's see what GameStop is. So look, GameStop actually has lower volatility. Oh, wait, well, I'm doing a weird strike, but you can just kind of see. So I mean, GameStop, has high volatility, but if you compare it to like, let's just say Amazon, 18%. So the implied volatility can give you an idea of like where the market is thinking if this stock is going to move up or down. So it's a lower probability it's going to move as volatile as other stocks. Again, I showed you the equation. There's just a lot of things to consider. I used to tell people, think of it like an IV of 100%, but then you go to 200%, it's double the price. It's not necessarily true, but just kind of think of it like in terms of proportionability in a percentage wise. So like, it'll add 18% to the value of what the option is, stuff like that. Just like simple math, just so you can get an idea with that. Any other questions? Because we're right at the hour mark, but I can answer any questions about this stuff.
Yeah, I have a question on options regarding Theta. Do you multiply it by 100 or it's just per day the amount?
It's per day. Now I'm looking at Amazon. So this is again, and I like doing different examples so you can see just different stuff. So if I were to look at Amazon, so this strike right here, let me do a different color. So this is a call for $3,620. Let's just round this to 2,400 or 24. So 24 times 100 is this. So this option expiring tomorrow is $2,400. Immediately on open, without anything changing, it's going to lose about $480 because this is in a dollar. So this occurs every day. Now with options, that the sooner you get to the expiration date, the higher this is going to get. The further out you go, the lower it's going to be. Now, do I know the exact price? No, but it occurs each day.
Yeah, because it changes constantly, but that was the thing I wasn't sure, like Theta you will multiply by 100 since one contract is 100 shares, or if it was just per day.
Yep. That's why it's 100 shares, because these contracts are in 100. All these prices, these prices are just basically telling you per share, but the contract's in 100s, so you always multiply by 100. So that's why the Theta does apply each day. So and this increases every day the sooner it gets to that. So like if I were to look at like 2023, so if I look at Amazon, okay, so roughly 2 years from now, this Theta, it's going to lose $42. Now, $42 may seem like a lot, but look at what this options contract is worth. This is a $60,000 option contract.
Cool. Yeah. So right there, the Theta is 0.42. So you will multiply that by 100, right? And that will give you the 40. All right. Cool.
Yeah. So that means each day it's going to lose roughly $42 if nothing were to change. If this price goes upwards, it's going to go up, obviously.
Yeah. Cool. All right. Thank you.
Yeah. So any other questions before we end it? Well, thank you guys for coming here. I just did calls. I'll go over puts next week. It's similar, but a little different. But also next week I'll post or on Friday tomorrow, I'll post the events for next week. I'm going to do, I think I'm going to do three classes because I start I'm not leaving PersonaFi, but I start another job come the next week. But I'm going to talk about puts for next week. And then I'm also going to talk about how charts work and how to trade on those charts. So just keep your eye open on the events tab, and announcements tab. And yeah, so I'll see you guys then. I'll do it again at the same time at 5 p.m. I'm looking at maybe Tuesday and Thursday and Friday, not Wednesday. But yeah, so just want to say again, guys, thank you for coming in here. And if you have any other questions, you can DM me and ask any questions. So if you don't know, it's Chris Haven on there. And I'm one of the mods and also work for PersonaFi. So, but yeah, so just want to thank you guys and have a good night and stay safe.